Well, a very good afternoon and welcome to this first edition of Finweek Money Matters, the show that helps you manage your finances. I'm Bronwyn Nielsen. My co-host is Mark Ashton, editor of Finweek. And of course, we're also joined by Georgie, who is also from your team. Thanks very much for joining us on the show today. We take a look at Finweek's cover story, scaling down how richer South Africans are being forced to live within their means. Later on, Viv Govender from Vunani Private Clients shows us how to make money trading in platinum. And in our management section, Colette Samansovitz tells us why we shouldn't waste our 20s. And finally, Gareth Osher talks entrepreneurship and shows how to value your small business. Please do send us any comments or feedback to moneymatters@abn360.com. That email address again, moneymatters@abn360.com. Well, let's have a look now at this cover story. Nice car, big house, a Labrador with a hip problem. The suburban South African dream is slowly imploding. Sounds familiar? Well, for more, our special guest today, Georgina Engelbrecht, Finweek columnist, joins us on the desk. Thanks so much for your time to both of you.
Thanks, Brian.
Well, let's start with the South African consumer. We are in trouble. Do we know it? And Georgina, perhaps you take it from here.
I don't think so. I think if you look on the streets and at the person in the street as well, that you see a flashy car, you see a flashy cell phone. And that's the main thing that we try and present. It doesn't matter what kind of house you live in. I mean, you see those pictures on the internet of a guy stealing his electricity from the house next door, but he's got a BMW in his driveway. And I think that's very much the way that the South African individual feels that they have it made, if they've got the nice car. But so often that car is costing them so much more than they think. And I was at school and like a financial advisor came to speak to us and they said, every time we see a nice car on the road, think to yourself, that guy's in debt. And that's the bottom line at the end of the day.
Well, one question I have to ask you, Mark, is do you drive a fancy car?
I drive a good old Toyota Yaris. I have 3 children, so that makes it a little bit of a stretch. I mean, I think maybe just building on what Georgie was talking about. I mean, it was very interesting. We were at the Gateway Shopping Centre the other weekend, and going to the stores, you'd see a whole lot of fancy, you'd see a lot of the sales signs outside of all of these clothing retailers, 50% off. And standing in the queue at the Mr. Price, you'd end up having the situation where the guy was looking to roll his credit card over, or in Jet, you were rolling over 200 Rand to buy shirts and T-shirts at Jet. So there's some very definite things happening in our South African consumer. I think they're taking strain. I think you're looking at the unsecured lending numbers and you're seeing a lot of additional credit being extended, but it's very interesting just to see how that's starting to bite the average consumer.
Absolutely, and consumers continue to take advantage of these record low interest rates. It doesn't look as though we're going to see that trend reversing anytime soon. But Georgie, the question's got to be what happens when we do see a reversal, be it 2 years down the line, and suddenly interest rates go up at a fast increment.
I shudder to think, because it's still far too easy to get a credit card in this country. I know they've implemented stricter measures and all sorts of things, and that buffeted us somewhat in 2008, but still the amount of companies that send me credit cards in the post that I have to then cut up. And I don't think people understand exactly what it means to have a credit card. It's not free money. At the end of the day, banks are businesses and they want to be making money. And if you borrow from them, you have to pay them back with interest. When that interest rate goes up, it's going to be quite frightening. And I don't think the South African consumer actually fully grasps the concept of that just yet.
What are the trends in terms of the numbers? And now perhaps let's just refer to scaling down, which is obviously your cover story this week. How many consumers in South Africa are behind the pace on their debt payments?
I think one thing that really interests me is 10 million South Africans in under debt review at the moment. I mean, 10 million, and that's not your poor people. That is 10 million ordinary middle of the road consumers. It's you, me, my social circle. I mean, there are people there that are really battling.
And these are people who should have a handle on their
Correct.
finances.
And I think there was one, I mean, a lot of people have always asked me why we got involved with Finweek. I think the idea was there's such a demand for basic financial education at not a dumbed down level, but genuine level as to how do I manage my finances? How do I get involved in personal finance? How do I save? How do I invest? How do I just manage my money a bit smarter? And it was interesting to see the new car sales figures coming out this week. I mean, it was a phenomenal jump year on year. And you think, but where did that money come from? I mean, I know we will go out and we'll have drinks. And a few years ago, it was easy to put 600 or 700 Rand down on the table for drinks. And now you kind of nurse 2 Castle Lights and you hope that you make it through the evening. So I mean, I think that anecdotally you can see it starting to take a bite from consumers, and there's some interesting data coming out of the Old Mutual do their savings monitor, for instance, and South Africans are being forced to rethink about how they do the saving. What are they doing in terms of hard saving products? Are they saving through their funeral plans? Are they actually able to, instead of allocating toward life insurance policies, do they actually have the 3 months of hard savings that they can draw on in the case of an emergency?
What about school fees? That's another pressure point for South African consumers. Schooling is fast becoming unaffordable for many, would you say?
Absolutely. It's frightening from the word go with school fees. If you're looking at nursery schools even, if you've got two parents in the home who are working, which you need to have if you want to send your child to a good school, you're looking at nursery school from an early age, or at least someone in the home to help you. And so you're starting very, very early when it comes to school fees. Looking at some of the best private schools around the country, you're in for 120,000 Rand a year, easy. And that's not pocket change.
That's if you can get in, of course.
Exactly,
Because
of course.
I think that's another article that you've got to look at strongly, is the dearth of supply on the education front, but that's for another day. Mark, you wanted to make a point?
Yeah, I think I was just chatting to one of the bank CEOs of one of the local banks here locally, and he was talking about the stigma attached from moving your kids out of a private school. You've got the situation where you used to be able to afford to send them to this really fancy private school, and the reality is you don't have that money. You've been retrenched, or you've had to scale down your lifestyle. And I think that you're now seeing, and that's the last thing that people start to cut. But I think if you start to unpack a lot of the local schools, you'll find that there are a lot of parents amongst the well-to-do schools that are actually starting to take some strain. I mean, one of the stats that I did draw from the Old Mutual Savings Monitor, just coming back to the store accounts issue, was more than 60% of those polled in the Old Mutual Monitor had a store account, and that's almost double how many have a credit card at the moment. So you can see where people are spending their money. They're spending it on consumables. Woolworths, they've just recently done a trading update. I think 40% of their the purchases are now done on a credit card, and again, that's that middle to well-to-do part of society, and I think there's something happening there that I think we should be taking cognizance of.
Now, what is pretty much like a domino effect? What is going to make all this unravel?
Oh, it's difficult to pinpoint one
Are we going to survive? I mean, that's the question here.
I think it is incredibly difficult. I mean, I agree with it, Georgie. I think it's an incredibly difficult thing to look at, because you've got this. We're so used to visible consumption. We're so used to the nice cars. We're so used to sitting at a pub and drinking and having a good time. And it's very difficult to go back and say, I no longer can afford to actually be out and about. But I do think that it's starting to happen. I thought it would have happened earlier. But if you start looking at your social circle now, people actually say, I can't afford to go out anymore. I'm going out there and I'm saying, I want to put in, I'm going out for a few drinks. I'm not going over the top. I'm going for a nice dinner. I'll do a family dinner at Spur or Wimpy or whatever it is. I mean, there's a visible
we're actually
change.
starting to install our own austerity measures.
Correct.
The South African consumers taking
But it's
the lead.
also it's difficult, because your government says to you, consumerism is what drives the economy. So you've got this pressure to keep the economy going as a consumer, and yet you know that to protect yourself, you kind of have to scale back.
We'll come back to more on this a little later, but last week, Finweek and Saxo Capital Markets hosted an investment experience to give insights into the world of financial markets. Mark caught up with the CEO of Anchor Capital, Peter Armitage, and asked him about offshore investing and asset allocation.
Peter, listening to your presentation earlier, there was a lot of emphasis on yield. One of the interesting things you brought up with the opportunities for high yield offshore. I mean, maybe give us some thoughts of what your thinking is there?
Yeah, I think the basic issue is cash in the bank, you're getting naught, literally naught. A lot of people are earning nothing. Inflation offshore is running at 2 or 3%, so you're basically going backwards in value by 2 to 3%. So it's hard work to go and find the places to find the yield. Government bonds don't give it to you. You're lending money to Barack Obama at 1.5% per year, which we don't think is a good equation. So the things that we find value in are high yield corporate debt, which is basically it's high quality companies that have issued paper where effectively you lending money to the corporates. The corporates as a whole are quite healthy, and you can get about a 7% yield. Now you compare that to lending to the government at 1.5%. So we think that's pretty attractive. And an area that we think looks remarkably attractive is Australian property. Interest rates there are 3.5%, the base rate, and you can get yields on property, good quality property at low gearing of between 8.5% and 10.5%. So the property is in fact cheaper than South Africa, and interest rates are much lower. So when we scour the world and look for opportunities, we think that looks pretty good.
Any particular counters that you like?
There's two shares that we like. Two shares that we're very comfortable with because they've effectively got South African shareholders. So, we've got the comfort of chatting to the guys here and knowing how they operate. So Growthpoint Australia, which they're operating very much like Growthpoint South Africa, growing conservatively, step by step. That's trading at about an 8.5% yield. And then Cromwell is in the Redefined stable, which has got a good South African influence. So, we can go and knock on the doors here with people that we know and understand and get proper perspectives on it. And that's trading at closer to a 10% yield. And neither of these companies have got huge amounts of debt. They'll grow at 4%. So, the 8 to 9% yield plus 4% growth in a world where there's very little yield available, quite a low risk 10 to 12% growth we think is very attractive.
Listening to your presentation earlier, you spoke about the use of exchange traded products in your portfolio, and it's always quite interesting when you think of it as possibly being a stock picker's kind of market. What's the thinking there in terms of using those kind of products for your clients?
I think we've got a lot, we only want to do what we're good at, and we don't want to pretend to be what we're not. So in emerging markets, there's lots of companies. The company-specific risk is a lot higher because of issues over disclosure and corporate governance. So if we want emerging market exposure, there might be one or two companies that we buy directly, but we take our exposure through an exchange-traded fund, which is effectively the index, and you're investing at a much lower cost, but getting the exposure. We place a lot of emphasis on asset allocation. In other words, where in the world you put your money and what classes you put it into. So we want to make sure that the things that we buy match up with, the performance. If we say 20% in emerging markets, we want to make sure that we're at least getting the emerging market index exposure. So we tend to put half of that in kind of an exchange-traded fund and then put some shares that we've got high conviction in the rest. So hopefully you get that exposure plus a little bit.
Do you think South Africans are finally waking up to the fact that there are opportunities beyond our borders? We seem to be very slow to look at offshore, and obviously people have been burnt in the past in terms of low returns and not really had much in the way of dividend yield. But there's more and more accessibility to international exchange-traded funds, international companies. Do you think South Africans are waking up to that?
I think it's, the ability to invest offshore over a 50-year time span is actually pretty new. So it's only in the last few months that you could take R1 million without any question asked offshore, which is a lot of money in the context of the average wallet. So the average South African can invest really as much as they want to offshore. People haven't really known how to do it. Technology has made that a lot more accessible. Even a few years ago, if you wanted to buy a share in London, you'd be paying 1.5% brokerage. The technology solutions nowadays bring that down to, 20, 30, 40 basis points, depending on what you're buying. So it's a lot cheaper. South African companies are starting to service people who want an offshore offering. It didn't really make sense for businesses like ourselves to put a lot of effort previously into giving people offshore advice because they didn't really have money there. So, it's a chicken and egg. We're starting to do a lot of offshore work and give people offshore advice, and we're starting to see the money flow through. And
finally, looking at South Africa, bullish about the opportunities for the country as a whole. I mean, do you see things that concern you?
I think South Africa, you've got to distinguish between the economy and the stock market. The South African stock market is not the South African economy. 75% of the South African stock market is in fact non-rand earnings, either resources or the likes of the Richemont's British American tobaccos. So only 25% is the South African economy. Within that, those shares have actually done very well. I mean, the foreign investors have got quite excited about the emerging market game. The issue, what worries us is a lot of the high consumer spend has come out of the equation of real wage increases being higher than inflation. Now, that's not something you can sustain over time. So South Africa needs to increase its productivity and play some other tricks to make that sustainable. So our concern is that the momentum that's been there behind the companies and their share prices needs impetus from productivity but interest rates are coming down. That might be the next leg. So the story certainly can continue for a while.
Excellent. That's Peter Armitage, CEO of Anchor Capital, and Mark Ashton for Finweek.
And let's head into a short break. More Finweek Money Matters straight after this break. Welcome back to Finweek Money Matters. Joining us on the desk for our investments section is Viv Govender from Vunani Private Clients. His investment hotspot for the week, platinum. Viv, you're under pressure. It's going nowhere, my friend. Where are we? $1,400 an ounce on platinum at the moment?
Or just below that at the moment, yes, we are.
But you're optimistic.
I'm optimistic. I think the fundamentals of the metal are so strong that one would find it very difficult to argue why it would fall significantly below where it is right now. And there's serious pressure for it to go quite a bit higher. We in South Africa make most of the world's platinum. So the issues that we have in each individual platinum company, be it strikes, be it electricity, etc., is going to affect the entire sector and just increase costs and therefore increase the pricing of the metal as well. And demand is going to increase as well. We've seen car sales beating records everywhere besides Europe, or beating expectations in everywhere besides Europe at the moment. And that's obviously going to increase demand for platinum as well as some new regulations coming through over the next few years.
Does that mean that your outlook for the economy, the global economy, is a positive one? Because I can't see demand improving unless everything is on the side of a better world.
Even if the demand was to like tip off a bit here, it would not affect my case so much, because the fact of the matter is that a lot of the platinum being supplied currently at the moment by South Africa, and as I mentioned, we are the majority supplier in the world, is being supplied at a loss. The miners are not making money on this at these levels. And so even if they don't have an increase in demand, the miners just can't continue to supply at these levels, and therefore they have to have a higher price or reduce supply.
Mark, are you convinced?
Yeah, I mean, I like the platinum story. I mean, I've got a few bucks in on the platinum trade at the moment. I think for me, it's fallen so far. The fundamentals of the mining companies are such that they're not great. And we had security issues this week at the Aquarius Platinum. We've had the Rustenburg Platinum issues. I think the question I would have for Viv is why the metal over the underlying companies?
Well, the underlying companies, quite frankly, are going to experience quite a bit of headway. You mentioned production issues. You've mentioned things like, for instance, they're going to have to lay off workers. They may have to cut down production, especially if the prices remain near to where they are right now. And that is obviously going to be quite negative, especially in this economy that we have right now, and the kind of government, in terms of, if we do see a drop in supply, which may be required to increase prices, these companies are going to face quite a bit of headway from unions, etc. So the companies themselves have a lot of negatives. And secondly, government's talking about introducing new taxes on resource companies especially. And that means it's going to basically cap off maybe some of the upper end of any increase in prices. On the other hand, with regards to the metal, the fundamentals are so strong with the metal, it's much harder to argue that there's much downside. It's much easier to foresee a future in which the prices are going higher. And
in terms of instruments for retail investors to get exposure, I mean, how do you gain exposure to it?
You have to use the ETNs, unfortunately. And yes, they do have, some of them have slightly larger spreads, as you want to expect with the ETNs. The market makers aren't as diligent as they should be. But I mean, I'm looking at a significant move higher, and you'd be looking to the ETNs to get into the platinum market.
Georgie, you want to pick up on that?
Would you suggest possibly going long platinum the metal and maybe doing it against shorting one of the platinum miners, just to sort of hedge your bets a little bit there?
Maybe that could be a way to go about it. I wouldn't be too...
Is that too brave for you?
Too brave for me, yes. It is too brave for me.
I wasn't derivatives, I suppose.
The reason being as follows is that, yes, we are arguing some of the risks with regards to the platinum miners out there, but they could get their story right. And if they do, then any increase in the metal is going to be multiplied through the miners, because obviously they will be having a kind of a multiplier effect, a 1% increase in the price of platinum will be a multiple of that increase in the profits for the miners if they get their story right. And who knows, they might just.
The long and short of this, aggressive supply side constraints will prevail. Would that be a good summation?
Yes, and also demand is not as anywhere near as weak as people fear. Yes, Europe is the #1 demander at the moment, but we are going to see demand picking up from the rest of the world, and also new regulations coming through, not just in Europe, but in America, in India even. They are increasing basically regulations with regards to emissions, and that's going to be very positive for platinum, which is being used for the catalytic converters.
Let's talk about the stocks. If you were to go into the majors, would you prefer Impala Platinum or Anglo Platinum?
Well, probably Anglo Platinum at the moment. I just think there's just been maybe a bit more, upside. It's come down quite strongly. I do think they are taking the right moves. So we've seen recently with regards to workers, they have had a move where they're going to fire. Unfortunately, it's bad for the workers, but it's good for the company. They're going to fire some workers from the support staff. if they take more, diligent efforts with regards to basically cutting down production at mines that are not profitable at the moment, that's going to be very positive for the company going forward. Also, it basically is going to be positive for the metal price, and also going to basically reduce current overhead, and also keep some metal in reserve, because, like I said, we have a lot of the world's reserves, and maybe we want to use that in the future.
But for the CEOs of the platinum mining companies right now, it must be many, many sleepless nights.
Well, I think it's been quite a. I mean, I think being a CEO of a platinum miner at the moment is a very risky place to be. I think there's been a lot of politics there. I think I think typically platinum miners go through boom and bust. I mean, when things go well, they go very well. When they go badly, as they have done now, I think you get a lot of pressure. I mean, Anglo and Anglo Platinum, Impala Platinum, the issues they're facing in Zimbabwe. I just think that it's. Yeah, when it's good, and when it's bad, it's really bad.
But the cycle will turn, and this is a very brave trade I put to Gary Boyson from Vunani Securities the other day. I said to him, if we know that platinum is going to recover, it's as inevitable as the world goes round, then why don't we just buy these beleaguered platinum stocks across the board, lock, stock and barrel, and wait for the turn to come? You've got a huge kicker.
Because the kind of cycles are quite long sometimes, and so you may be sitting on this platinum cycle waiting a year or two down the line, and the stocks.
I'll wait a year. I'll wait a year for that kicker.
And the stocks may not recover, or we may find some kind of issue with regards to government regulation coming through, and that's the kind of issue with the miners themselves. They are actually producing platinum, and they have an operation they have to run in the face of possible government intervention, in the face of higher taxation coming through. So the miners themselves may be in trouble. What my argument is that the platinum price at current levels is unsustainable. If it's unsustainable at current levels, it must increase over time. And therefore, it's a much safer bet to go for the metal itself as opposed to the miners, which may, even if the metal price goes to 2,000, doesn't mean the miners are going to benefit, especially if we have higher regulations and more.
Are you saying then that the platinum miners are in trouble and they could remain in trouble for the rest of their lives?
They could remain in trouble for quite some time, especially if government puts some.
But not the rest of their lives. What is quite some time?
Who knows how government is going to play this thing? If government does come into play and put a huge, for instance, taxation on some of these platinum miners out there, they may just be able to break even for quite a few years going down the line. They may never be able to make huge profits, because if platinum goes to $10,000 an ounce here, if government takes half your profits, what does it mean for the miner itself? And that may be an argument people say is facetious, but look at Argentina recently. We've seen a huge increase in the price of soya. What does the government say? A 40% tax on soya farmers.
Well, the Australians did it to BHP with the mining tax at the beginning of last year.
Yeah.
So it's not unheard of.
Yeah. So it's
absolutely. So we've got to be cautious about the regulatory environment. I know financial advisors are not going to agree with that all eggs in one basket trade, no diversification. But if you believe the world is going to recover, ultimately platinum stocks, even if it is a 5-year or a 7-year view, will recover. Is that just a little too outlandish in terms of my thinking?
No, I think if you look at it if you look at over a historical cycle, you will see that it does turn. I think your question is going to be at what point what is the cost of capital of leaving that money for 2 years waiting for a cycle to turn when there are other opportunities. If the opportunities are sitting in the metal itself, then maybe that is your entry point.
Right, Viv, so before we go, how long are you giving this trade on the platinum story? How long do you think we're going to wait until we see the platinum price itself start to respond to the aggressive supply side constraints we're speaking about?
Look, the timing is obviously going to be quite difficult to put into place, but I've seen encouraging signs. Aquarius has cut down production. East Platts has said they're not going to expand. Longman has come out with basically saying we're going to put our heads into a shell and just basically wait until this whole thing, until platinum prices start to recover. So we are already starting to see the miners themselves reduce production. People are saying there's maybe a year of excess surplus coming through, but I'd be very surprised in 2 years' time if we don't see platinum prices significantly higher than where they are right now.
Viv, thanks very much for your time. Viv Govender joining us here on Finweek Money Matters. Georgina, the Finweek trade of the week. Now, this is what everyone's been waiting to hear.
No pressure then. Well, staying in the commodity vein, I've decided to look at gold, but not just gold purely as the metal. The best thing that ABSA has going for it at the moment is its new gold ETF.
I hope was not listening to that comment.
Where you're basically getting the price of gold in rand terms. And gold itself is only about 3% up year to date, which is, I think, its smallest yearly increase since 2005. And so there is a space for a significant move higher. If you looked at gold's move last year, in amongst sort of very similar conditions globally to what we're facing now, there is a lot of room for upside, not necessarily to the exact same level, but percentage-wise, there's definitely that room for the metal to increase. And then to slightly give yourself a bit of a better chance, the rand is facing volatile times ahead. Let's be honest, it is an emerging market currency, and when risk-off trade happens, the rand is going to depreciate.
We are going to continue to be volatile. Risk off, risk on. It buffers our local currency. Get over it, really.
Yeah, pretty much. So if you've got a gold price that's appreciating and a rand price that's depreciating, that's going to be great for the new gold ETF. And so that's why that's where I'm putting my money at the moment. And I think you've got to give the Chinese some competition. I mean, the world knows that they've told that they have to hedge inflation by buying gold. And I wouldn't be surprised if it's part of their government's plan to train little Olympic champions to increase the level of gold in their stores.
And we know this is an emotive story. When we start talking gold on the CNBC African news desk, we start being flooded with emails. I'm sure you find the same thing in Finweek when you write about it. So, Georgina, brace yourself. You're going to have the gold bulls following you now. You're going to be their shining light going forward. Do you agree, obviously, with the gold trade at this point?
Yeah, I think I believe there's a lot of opportunity in both in the commodity space. I lean a little bit more toward platinum over gold, but I think compared to equities, I think that's where there's some opportunities. There's hard commodities. If you want something a little bit simpler, look at that Standard Bank ETN for the Africa Commodity Index. Gives you a bit of platinum, a bit of gold, but of some of the softer commodities as well. But yeah, I think that's where your opportunities are for hedging your portfolio at the moment.
And before we let you go, I know we've done the platinum